Well, today we reported the Westpac Melbourne Institute Consumer Sentiment Index rose by 4%. It's now hit a 10-year high, and it's now 48% above the low that we saw in April. We also saw confidence around the labour market lift to a 10-year high as well. And there was a big jump around 9% in people's expectations for house prices. If we look back and compare this cycle with the slowdown that we saw in the GFC and the recession we saw in the early 90s, we see a much more rapid recovery in confidence. In the early 90s, it basically took 3 years before we could confidently say that sentiment was on the rebound. And in the GFC, it was about a year, whereas this time we're very confident that after 8 months, with the index 48% above the low point, that confidence has very much recovered. That has been a big factor in our thinking around our forecast for GDP. Late last week, Westpac revised up its growth forecast for 2020, 2021. For 2020, we revised our growth forecast up from -3% to -2%, and for 2021 from 2.8% to 4%. For 2022, we've slightly shaved that number from 3.5% to 3%. Those increases in growth are consistent with faster employment growth, and we now expect that the unemployment rate by the end of 2021 will be 6% rather than the previous estimate of 7%. And at the end of 2022, we expect the unemployment rate will be down to 5.2% rather than 6.3%. So today's numbers on sentiment have given us even more support for our optimistic view about growth in the Australian economy. Indeed, with these growth forecasts, we expect the Australian economy will be back operating at the level it was operating at in late 2019 by the June quarter of 2021, and consumption will also be at around about that level. So why are we saying that we've got this strong lift in growth? It's all about the consumer. So if we look at the consumer story in 2020, in the June quarter it collapsed by 12.5%, rebounded by 7.9% in the September quarter, and we expect that when the data is released, it'll show that spending improved by another 5% in the December quarter. But I think the groundwork is there for a strong lift in consumer spending in 2021 as well, and we predict a 5.7% lift in 2021. The real dynamics will be around the income growth of the consumer relative to their spending. And while many people are saying the elimination of JobKeeper and low wages growth will mean that consumer income growth will be so low that a poor year of consumer spending is likely, we expect there are many other factors that will offset this particular risk associated with weak household income growth. The first one is strong consumer confidence, and today's result has even strengthened that view. Secondly, we expect that the government's budget that's coming up in May next year will continue to be supportive of household incomes. I believe that even though JobKeeper will have expired by the end of March, that the government will be very focused on supporting those firms and those industries that are still being affected by the COVID crisis. So there will be a boost to household incomes in that regard. We also expect rising house prices. Once again, as we saw in the sentiment survey today, a 9% lift in expectations around house prices. That'll lift activity and it'll lift the wealth effect from consumer spending. But most importantly will be the savings rate. So we've seen a huge lift in the household savings rate over the COVID period. It got to 23.9% at the end of June and is still at 18.9% at the end of September. So what we have is we have an accumulation of household savings that are going to provide an exceptional buffer in 2021 to support strong spending, even if household income growth is modest. On the other hand, of course, there are risks around the deferred loans that the banks are having to deal with, but we expect that that will be a very long drawn out process and really won't be impacting upon these positives. And of course, the final positive is the introduction of the vaccine. That's going to boost confidence, it'll accelerate the freeing up of borders, and it'll certainly boost the overseas economic activity, and that of course is likely to boost financial markets, which of course will also help confidence, incomes and consumer spending. So that's the scenario that we're looking at in 2021, 2022. From the central bank's perspective, a 5.2% unemployment rate by the end of 2022 suggests that sometime during that year they will be unable to continue to provide that forward guidance that the cash rate will remain at 0.1 for the next 3 years. So we'll see activity in the markets as markets try to work out exactly how the Reserve Bank will react to that. It's even possible that that sort of activity will be brought forward into 2021. But could this benign story be totally unrolled by the China story? Let's think about the impact that China has on the Australian economy. Australia's exports are about 420 billion a year, and China explains about 150 billion Australian dollars of that. So around 35% of our exports go to China, by far our largest trading partner. But when you look into the makeup of those exports, you notice that around 70 billion is iron ore, around 20 billion is LNG, and 10 billion is gold and base metals. I would say that 100 billion of the 150 billion is very safe. We know that China needs the iron ore. In fact, our biggest competitor, Brazil, is having trouble with their production levels based on their issues around COVID. So the question mark will be around the other 50 billion. There's about 18 billion in coal, and at the moment both metallurgical and thermal coal is being blocked. But we think that's to do with end of year quotas. We expect that next year China will be having to free that up. And because of the huge surge in steel making in China at the moment, the price of coking coal is rising, and there's clearly a need for more coking coal. Even if these markets don't reopen in China next year, we believe that Australian producers will be able to find other markets. The biggest concern is around the 13 billion in agriculture. And of course there we've seen concerns around wine, cotton, barley, seafood, all of which represent about $1 billion in exports. And for instance, wine, 36% of our wine exports go to China, so a huge reliant upon that China market. We're now starting to hear concerns about beef and lamb. Total meat exports are around 3 billion. So we have to say that the whole of that agricultural profile has to look for other markets. But unfortunately, in terms of the overall impact on the Australian economy, it is still quite small, only about 13 billion. Finally, we have about 18 billion of services, 12 billion of students, 6 billion tourism. The student question, of course, is quite perplexing. China represents about 33% of our student exports, and how the foreign students decide in returning to Australia, we know the universities are working very hard to do that, and of course the development of vaccines will be important in that regard. Leaves about $6 billion for Chinese tourism, and of course that may well be under some risk. But on the other hand, in terms of the overall macro story, we've seen the iron ore price lift to nearly $150 a tonne. Bear in mind the government in its budget was talking about $55 a tonne. And even back as far as June, it was around $80. So the value of our iron ore exports, which represent almost 50% of our total exports to China, is increasing very rapidly. So from a macroeconomic perspective, the overall impact on the Australian economy, whilst some shocks to certain sectors, particularly on the agricultural side, the huge offset will be this extraordinary rise in the price of iron ore and our major export commodity. So in summary, the outlook for the Australian economy next year is very positive. 4% growth, a fall in the unemployment rate to 6%, and further falls in 2022. It's going to be another interesting year. There'll be lots of other factors that we haven't really thought about that no one is aware about at this stage. But certainly I'm feeling very, very positive about the outlook for the Australian economy next year. Thank you.